I'm Fred McClimans of Samadhi Partners, and on this edition of Perspectives on Tech, we're taking a close look at some of the key events in the tech sector that caught our eye over the past week. In particular, we're going to take a look at AMD and their release of Ryzon, Inovalon's earnings, MobileIron, who just launched a new IoT cybersecurity unit, and then also Xilinx and perhaps even Ansys and their earnings. Joining me today are John Freeman and Zach Mitchell, also of Samadhi Partners. Gentlemen, welcome.
Fred, how are you doing today?
Doing very well. Zach?
Yep, doing great. Thank you for having me on.
Welcome to your inaugural. Inaugural. Yeah, it is.
Yes.
Yeah. Your inaugural Perspectives on Tech.
The crowd was huge.
Yes, the crowd was huge. So before I get into this, before we get into this, let me just make it clear to everyone that this is for informational and entertainment purposes only, and we hope people are informed and entertained. But that's it. We are not making stock recommendations, nor are we trying to offer, or nor should any advice on stock recommendations or picks be implied by what we're saying. So with that, let's kick this off. John, AMD,
Right.
one of those chip companies that we love to love. They've been quiet in the CPU space for 3-4 years, and they just dumped Ryzon onto the market.
Well, so the reason that we liked AMD, say 6 months ago, and it's been, it's obviously performed extremely well as a stock, was primarily the GPU part of their business, the graphic processor unit part of their business, which is now not just for graphics anymore. You can do a lot of other stuff with it. I didn't really put a whole lot of hope actually into Ryzon. So the specs look good. What they've done is they've done some interesting things in terms of instructions per core and all this kind of technical stuff, basically squeezing more performance out of an x86 CPU for certain applications relative to Intel. So for certain applications, they will likely take a significant share. And one of the other interesting things about this is that historically, AMD has always had been a node or a node and a half behind in terms of Moore's law. That is, the transistor density of their chips, was always behind Intel, because Intel, with they're Intel, they're always leading. Traditionally have led Moore's law, and now they're not. Intel is kind of stuck at 14 nanometers and is really struggling to get to 10 nanometers. Meanwhile, AMD, which uses I believe it's the second largest foundry, which is Global Foundries, TSMC being the largest foundry. But Global Foundries, basically, what they did is they skipped a node. So that even though they're small, they were able to skip a node at 22 nanometers, suffer a fair amount of market share loss, and then kind of come back again at 14 nanometers. So it's bizarre. Global Foundries and AMD are now at the same node as Intel, and it looks like they're going to be there for the next year or so. So that's an interesting competitive change that advantages AMD relative to Intel, particularly if you look at it from a historical basis.
So looking at this, at the Ryzon chipset, there are 3 chips, or 3 processors that are coming out with this. Everything that we see on this from a pricing perspective is very clear. They are undercutting and directly attacking Intel's space and Intel's previous dominance in here.
That's right. And they can do that because AMD's gross margin is significantly lower than Intel's. So for them, it's what we do. And for Intel, it's like, damn, now in order to be competitive, they can't get 60-70% gross margin anymore. They're going to have to be satisfied with 50% gross margin, at least for those applications where Ryzon competes directly with Intel CPUs. So it's a very smart pricing strategy on AMD's part.
Now, one of the things that has had my interest for a while are the rumors of potential deals and licensing between AMD and Intel. And these are kind of...
On the GPU side.
On the GPU side. They've kind of come up, they've kind of faded down a little bit.
Right.
I look at this here and the competitive positioning that AMD is now in, and I can't help but ask, 2 questions. One, is there a deal to be made here on the licensing side? And 2, what does AMD do to follow this up on the GPU side?
Right. So here's my take on this. I think it's kind of interesting because Intel's problem is not AMD right now. Intel's problem is the fact that they can't get into mobile. They keep falling all over themselves, and they're not very good at acquiring companies. And they acquired, Infineon as a way to get into the baseband processor and cellular space and smartphones and all that, and they still really haven't gotten any market share. And so they've got bigger issues than kind of messing around with AMD. So AMD can kind of leverage that and take a little share on the CPU side and perhaps broker a deal on the GPU side, because what's going on with GPUs is that they are now being increasingly used as coprocessors. It's just starting to happen. They're being used as coprocessors in servers, not for graphics processing, but for processing this, for lack of a better term, cognified software, machine learning,
right.
Those kinds of really sort of tough, computationally tough applications. And of course, that sucks money out of Intel's pockets, because the more processing on the server side goes to a GPU, the less it goes to a CPU.
Right.
So so the GPUs are, and obviously who's the big GPU player? It's really NVIDIA.
NVIDIA. That is the giant elephant in the room.
Exactly.
That is occupying the entire
room. Yeah, so
room.
I mean, it's almost a duopoly between NVIDIA and AMD. Yeah. So Intel's kind of has a vested interest in perhaps doing a deal with AMD to ameliorate the issue, the bigger issue, which is they're losing market share in the one place that they still have growth and pricing power, and that is in the server side, because obviously PCs are in decline, and Intel still hasn't been able to figure out how to take any sort of material share in mobile yet.
So bottom line on AMD, we like the company. It is a member of the Samadhi Capital client portfolio.
Yep.
It is
Samadhi 16.
Samadhi 16,
Yep.
our high conviction category there.
Yep.
Moving along, Inovalon, INOV, just released Q4 earnings. Zach, can you give us a quick rundown on their numbers there?
Sure. So Inovalon, in the middle of the fourth quarter, reduced guidance actually, and ended up releasing beats on both the top and bottom lines. So revenue for the quarter were $96 million, and earnings were just positive for the quarter as well. Again, also beating expectations.
That's great. That's one of those things where you always love to see the beat, but when the beat has been hedged.
Yeah. That's after 3 quarters of slashing guidance.
Yeah.
Now, but having said that, one of the there's also a lot of regulatory uncertainty, which is affecting Inovalon's customers. Inovalon basically provides analytics and data on patients, on patient outcomes. So under Obamacare, and any sort of more results oriented or results tilted healthcare systems, they benefit because you want that data and those analytics to improve your outcomes, because then you get paid more. That's kind of the simple. So now it's kind of all up in the air. So that's why the customers are kind of hesitating, and it really took a bite out of their results. But fundamentally, long term, that's a company with a very unique position. So we think we're still long and we're still strong there. But yeah, I'll go out on a limb and say that Inovalon's probably the stock's probably not going to be rocketing back up anytime soon. But it is a great long-term holding, and I think if you look at it 5 years from now, you can look back and go, wow, that was a great potential entry point.
Yeah, I agree with you on that. They're a sprout in the Samadhi Capital client portfolio, and long-term, I think just the fundamental business model that they're in has tremendous value, tremendous potential. But in the short term, I see a lot of volatility for these guys. The missed expectations here and there, and they still have to prove themselves to me short term.
Yeah, I think the I agree with you. I think the upside is muted in the short term, but I would say the downside is probably fairly limited, given the fact that the company has the stock has taken a whack. They do have a fair amount of cash on the balance sheet. They are profitable. It's not like they're losing money. So there's kind of, in my view anyway, I think there's a little bit of a cushion there. But yeah, fair enough. I mean, they really did have a rough 2016.
Yeah, it has been a bit rocky. So moving along here, MobileIron. Two of my favorite subjects, mobile and cybersecurity. MobileIron just launched a new IoT division. And when I look at MobileIron, fundamentally, I'm very bullish on the cybersecurity marketplace. Right. But more importantly, I'm really bullish where you actually see applications that, are not just in that broad scope of we're gathering data, we're analyzing data. There's a lot of that out there. Yeah. And these guys are very tied into the mobile space, and I like their security approach for that.
Yeah, it's very practical. So MobileIron is their bread and butter is mobile device management, smartphones, and smartphone security for large enterprises that have people accessing emails and applications from the enterprise. So that's their bread and butter. And I think the IoT space, it has a lot of similar sort of aspects to it, and therefore in that there's a how can I put this? When smartphones hit the market, one of the last things enterprises were thinking of was about security.
Right.
And then they kind of had to backfill, so MobileIron was able to benefit from that. I think IoT is kind of a similar situation. I mean, everyone's excited about all the opportunities, but there could be some really, there's some really dangerous things that could happen, cybersecurity-wise, with IoT. Yeah. And so therefore, I do think that getting ahead of it in this case, I think it's a real good. I think it's a real good move. Similar sort of core competencies are necessary, and it potentially could be a bigger TAM, total addressable market, than smartphone security. I mean, it's if you really think about it.
Yeah, it is big. I think the challenge there is that the majority of IoT devices, they're not something that people look at and go, oh, tens, hundreds of dollars, in cost here. It's pennies, it's dimes, right. It may be dollars, right. In there. So, embedding security into that is a challenge.
And you have to embed it. You can't run it on. There's no operating system on a sensor.
Very difficult to add after the fact. A lot of work needs to be done there. But I'm particularly pleased to kick this off. They brought in a gentleman from Wind River, an Intel company.
I know
used
Wind
to run
River.
their IoT division there, and I think that's a very good move.
I think
he's
it's
a seasoned guy, and we expect some positive things coming out of that.
And he also knows the world of non-standard processors and microprocessors and microcontrollers, which is a world that you have to navigate if you want to get your software in there and then be able to charge somebody a license or something like that. Yep. I'm not exactly sure how the business model is going to work, but it's probably going to be something along those lines, per device sort of charge or something. Yeah. The last thing I'll say about MobileIron though also is that this is a relatively unique, I wouldn't say unique, but it's a fairly rare overlap of core competencies, the security and mobile and, sort of very, very, very lightweight software. So that makes them a very attractive acquisition candidate. And they're not, the market cap is like, 300 million? It's not a large company. And they do actually have cash on the balance sheet. There's a lot of reasons to like the stock, even if it weren't an acquisition target. But we also think it might be very well an acquisition target. So
yes, in fact, I do need to point out that MobileIron is a target in the Samadhi Capital client portfolio. But more importantly, it's also one of our top 10 acquisition picks for 2017. Let's talk about 5G now and Xilinx that just announced a new breakthrough with their 5G architecture.
Right. This is fascinating to me because normally, so Xilinx is the market share leader in FPGAs. FPGAs are chips that you program one time and for a specific task, and they're fully programmable, but you program them once and then you can't change the programming, and then it runs much faster than a CPU and so forth and so on. What they've done here is they've created, and FPGAs are used very commonly, and I think it depends on the year because obviously cellular base station and infrastructure deployments are very cyclical. We had 3G, boom, and then falls off, and then 4G, boom, and then it falls off. And in both of those booms, Xilinx did very well in the base station market. So they sell a lot of their FPGAs into these base stations that are deployed, all over the place, and so forth. So. But they're alongside analog, a lot of different kinds of analog chips, which are necessary to translate, basically, convert your analog signal into digital, and then the FPGA does your digital processing. What they've done is they've actually been able to build the analog functionality directly into the FPGA. So it's a mixed signal FPGA. I believe this is one of the first times I've ever seen it, at least for this particular application. Right. And it allows Xilinx then to essentially take share of wallet from some of the analog providers like Skyworks, maybe Analog Devices. It's really tough to say. Or Micro. There's a bunch of players in there, but I just thought that was a very sort of ingenious, I don't know, obviously not easy to do, but a very, very clever strategy. And my hat's off also on the technological challenge of doing mixed signal in an FPGA.
Right.
Really interesting stuff. Another thing about their architecture, which I've noticed, they're one of the very first logic companies that is going 3D, at least in terms of packaging. So not on a single chip, but they're packaging and then connecting two chips together to get two levels of circuitry. Obviously, it's a great way to extend Moore's law, transistor density, without having to make thinner lines, which is getting really expensive. So now we've seen this in memory. Obviously NAND flash has gone 3D and so forth. But Xilinx one of the first companies, first logic companies, really to push that going 3D strategy for logic chips. So anyway, I just in terms of R&D and the new stuff they're doing, I've really been very, very impressed with Xilinx, probably more than any other semiconductor company.
So they're going to take some wallet share away from a few people. That almost always translates into increase in revenue. But more importantly, for Xilinx customers, is there a cost reduction that takes place?
Oh, of course, yeah. Now you're basically getting a 2-for-1. I mean, it's that simple. And now, and as long as the performance is in the ballpark, then the choice is kind of pretty easy. Everybody likes lower footprint, and further integration usually wins, right?
Yeah,
if it doesn't win the first time, it's going to win maybe 2 years later when everybody goes, okay, finally, the performance is good enough and so forth.
That's a point worth noting there. It's not just the cost savings between the discrete components now merged into one, but it's also the real estate on the device and power that for the device that their customer is actually building.
Correct.
Okay, so Xilinx, they are a member of the Samadhi 16.
Yep.
Our high conviction category. So let's move along here and close out with Ansys that just announced their financial earnings for last quarter. Zach, can you give us a quick rundown on the earnings announcement?
Sure. So they reported last Wednesday, and they beat on both the top and bottom lines, actually posting record revenue and EPS for the quarter. Revenue was $271 million for the quarter, and EPS of 80 cents a share.
Okay. So John, Ansys, at one point they were one of the four, the Samadhi 4 in our portfolio. They're now in the 16.
Correct.
Looking at this company here.
Looking back, damn it,
we should have kept them.
Should have kept it in the 4, but that's okay. So the stock's done extremely well. It's gone from 63 to, what did you say it was at the 63, the end of January, right?
Yeah,
it's 63 to what now? It's at close today is 107 or something.
Zach, can you pull that up?
That's
a nice move. I think the report on in the quarter, the beat was, people were really excited about the return to growth. So they had a couple of years, they had almost 2 years there of really sort of almost no growth. And they, sort of reaccelerated to 7.5% top line growth. That doesn't sound, smoldering, but it's a reacceleration. And their business, the reason that you love Ansys is that business is so solid, and they have such great long-term drivers behind them, and such high barriers to entry. They do simulation software, so to simulate all kinds of different products and for product development and rapid prototyping.
Yeah, engineering firms love their software.
Love it, and it's just, that is so hard to replicate. That is software that is just really difficult to no startup's gonna come in and take share from them anytime soon.
Yeah.
And so they're a great long-term holding. So when they go from 2% growth to 7.5% growth, that's a big deal, because and you see the appreciation there reflected. Okay. And they are also, I think, just sort of when thinking big picture here, we like companies that we think are quote unquote on the right side of Moore's law. That is a company that can take maximum advantage of each subsequent, each future Moore's Law cycle and improvement in processing and memory and storage and all that stuff and network throughput and add value to its customers. To the degree that it can do that is the degree that it adds value to the shareholders. That's kind of our mantra, right? And there's no other company, there are very few companies you can think of in software that take advantage of each Moore's Law cycles more than Ansys. I mean, their stuff, every time you get a Moore's Law cycle and you get a doubling in processing power and particularly memory, and Ansys just improves their product tremendously. They can simulate more things. They can do more multivariate analysis. They can do better prototyping. They can do it faster because sometimes the simulations take hours to run still. And so to the degree that they can improve their software and run faster on faster processors and so forth, is the degree that they can sell a customer an upgrade and then get a new customer to go, you know what? If I don't do this, I am going to be left in the dust by my competitors who are rapid prototyping. And some of the statistics, obviously they're going to put some rose-colored glasses on the numbers, but it's quite clear that prototyping, in software is going to reduce your time to market. It's going to reduce your development costs. It's going to reduce the number of errors and warranty problems and all of those kinds of things.
Exactly,
so the value proposition is totally solid, and it gets better and better and better with each Moore's Law cycle. We love that.
So, Zach, where are they stock price-wise?
Sure. So they just closed today at $107, and that's a 16% change year to date.
Okay. Year to date from January.
Yep.
January 1. Okay. Impressive. John, real quick, if there were two things that could potentially concern you about Ansys, what would it be?
I think Ansys is sensitive because their customers are tilted toward manufacturing, big physical products, industrial companies. So they are more sensitive to macro. Macroeconomic issues than say, Facebook, for example, which could blow right through. People could be still using Facebook, and advertising dollars could still be flowing to Facebook in the event of a macro downturn. Whereas Ansys is going to be more sensitive to that. Other than that, the only other thing as I can think of is just on the margin. Maybe startups. Obviously, like we said, there's no startups going to meet them head to head, but they might be able to nibble at them and kind of take maybe some of the more interesting, advanced areas and sort of be a competitive issue. Competition hasn't been that much of an issue for Ansys. It's really been all driven actually by trying to just convince people that you gotta use this software. One of the barriers to entry one of the issues that they have, I guess, is just convincing a customer, hey, train your engineers for a year on this really hard to use software because simulation software is just sophisticated. It just has to be. It can't be. It's not simple. You just can't make it simple. So there is that sort of, you got to convince the customer to do a lot of work to buy your product and use it. Now, obviously, more and more, the more companies that use it and benefit from it and have case studies that say, if you're not using software simulation from Ansys, then what are you doing? Obviously, the better. But still, it causes a lag, I will say. It's kind of it's a tough thing for them to slog through. But the long term, it's just a great bet in my opinion.
Fantastic. All right. Well, with that, let's wrap up this edition of Perspectives on Tech. John, thank you very much. Zach, thank you very much in your inaugural Perspectives on Tech.